Good afternoon to everyone. My name is Stephanie Richards. While we are in New York, I'm actually based in Zurich working for Goldman. I run our Swiss and our continental Europe alternative capital markets business, so working with clients to put together custom private markets portfolios that invest in your traditional private equity, private credit, private real estate, infrastructure, co-investments, as well as hedge funds. So I'm delighted to be joined today by Tory Reiss, who is the CEO and co-founder at Equi, which is an alternative solutions provider for advisors, family offices, as well as high net worth investors. He's the three-time founder of venture capital-backed tech companies, and he pioneered finding Archblock, the driving force behind TrueFi, as well as TrueUSD, which has over $1 billion market cap. We're very excited to talk today about alternatives, which we find is an area is very interesting asset class, specifically within clients' broader diversified investment portfolio. If we were to take a step back and really think about what is investing in alternative asset class, it really comes down to kind of three main areas. One is as simple as just buying companies, providing finance, or actually physically owning assets. The reason we really like allocating specifically into private markets is you actually can see the value add that managers can provide to companies over the life cycle of their investment. And I think if you actually look at some of the historical returns, you can see that actually private markets have consistently outperformed public markets, and you really want to be kind of paid for the illiquidity that you're taking specifically in private markets, and you'd really want that 300 to 500 basis point of outperformance over the public market equivalent. I think when we think through specifically at Goldman, we actually spend a lot of time working with clients to put together custom private markets portfolios. Different from public markets where you might say you want $100 of exposure and you can buy the fixed income or equities accordingly. What we ultimately end up seeing in private markets is actually that there's a little bit more of an art than the science, where you might need to think through in terms of how much you're committing. That capital is called over a 2 or 3 year period. The manager might hold this, the investment for a set time period of maybe 4 or 5 years, and then obviously you start to receive distributions. So we spend a lot of time kind of thinking through the allocations as well. So maybe with that kind of as backdrop on kind of the macro landscape, we'll turn it over to Tory to walk us through Equi. And maybe, obviously you've started this company. It's really kind of breaking down barriers to make it easier for people to access alternatives. So maybe you can walk us through kind of the background, how you came up with the idea, what you guys are really doing and focusing on.
Yeah, happy to. So we noticed that there was a couple problems, and I imagine you see a lot of the same, which is when it comes to alternatives, there's definitely an education gap. And so one of the earliest investments we made was in creating content, attempting to bridge that gap and educate everyone about the importance, the role that alternatives can play in a portfolio. But a big inspiration for starting the company was this idea that, when you invest in alternatives, a lot of times investors will take it for granted that they need to be locked up for 7 to 10 years at a time in a venture capital fund or a private equity fund. Those are the typical fund lives. But there are increasing amounts of liquid alternatives and new structures that are emerging in popularity that allow for at least quarterly liquidity on alternative investments. And that allows them to play a larger role in a portfolio for investors that might not have a 10-year time horizon that they're investing over, that they're comfortable taking illiquidity in. And so that was really, our focus was thinking about how can we apply technology to create new products in that area of the market, which is this more, liquid alternative part of the portfolio. So something I'm actually curious about is on the Goldman side, when you look at how your clients' allocations are changing, given the changing macro environment, what are you seeing in terms of the shifting portfolio priorities and allocations?
Definitely. So I think if we maybe take a step back and we think through how to allocate to private markets, if we had a blank sheet of paper and you were putting together a diversified portfolio, we would say that you should invest something around 20 to 25% of your investable portfolio specifically into private markets. Now, underlying that 20 or 25%, that would be diversified across private equity, credit, as well as real assets. And the way we would think through that breakdown is you essentially end up with kind of just over half of that in private equity, so most of that would be in buyout. You would also have a little bit in growth and then a smaller portion in venture. And then for, call it that 45%, it would be roughly half of that would be credit, and the other half of that would be real assets, with majority of the real assets bucket falling specifically into real estate. So that would really be our starting place in terms of from an allocation perspective. If we look kind of thinking through building out portfolios and thinking about what's interesting right now in particular, if you kind of look at history, you can actually see, and the statistics will show that actually people that allocate in a similar manner year over year, so making consistent commitments, that actually in the long run will actually outperform. And so we really would suggest really just making kind of tweaks around the edges to the underlying allocation based on maybe within some specific vintage years what might be interesting. So taking right now as an example, within credit, you really have across the credit spectrum, you have at one end lower risk, lower returning, more of your senior secured lending strategies. You go across to mezzanine, and then you go further across to more opportunistic credit. We think right now both ends of those spectrum are actually quite interesting for investors. So on the senior side, you actually had rates obviously rose much more quickly than people had initially anticipated. For strategies that are income oriented, then you can receive that income as well. Also, a lot of leveraged finance desks within investment banks haven't actually been providing a lot of that financing lately, so a lot of large companies have actually had to go the private credit route. So some of the returns you're seeing there are also quite interesting and compelling. On the flip side, on the opportunistic side, I think we saw with rates having risen faster, inflation came in much higher a year or so ago. You actually saw a lot of companies kind of start to run into trouble, and we actually think over the next year or two there could be some very interesting opportunities there as well. So I think we would say kind of an overweight specifically maybe into credit. And then in kind of the private equity buckets, one of the implementation vehicles we would suggest would actually be secondaries. So secondaries are really where you're buying from somebody who needs to sell. So whether that be a large endowment or a large university or a large pension where they need to sell, we actually have been seeing some very interesting entry points. So last year, you all would have seen and heard about the denominator effect, where there are a lot of institutions with the pullback in both fixed income and equity markets. People had ended up with a larger allocation to the illiquid bucket, causing the need for liquidity. And we really saw discounts go from maybe 10 or 12% over the last decade to widening out to 20%. And so we still think there's some interesting opportunities in the secondaries market as well. So those would be kind of the more thematic areas where we've made changes specifically within the portfolio.
Got it. And okay. The other thing I'm wondering, and this is something we were talking about just before, is I'm not sure if everyone shares the view or is even aware, because we're coming out of such a long bull cycle, just how much expectations of what you can expect to see out of a portfolio and the equities sleeves, how that's shifting. And I'm curious to hear your firm's view, and I can share ours just in terms of, we think it's very common throughout market history to see these periods that we call, lost decades, where peak to peak, you can go easily 10 to 15 years without seeing a new high in public indexes, just a lot of volatility and choppiness. And it's our view that we're entering a similar period now, and that's a big part of why we felt it was a critical time to bring new solutions to market, new solutions for people's portfolio, and new applications of technology to allow them to invest in these types of investments and alternative return drivers really for their portfolio. I'm curious if your view and what you're seeing on the Goldman side reconciles with that, or how you might differ.
No, definitely. So I think we actually think now with volatility having picked up a bit, we actually think allocating to private markets is incredibly interesting. As you mentioned, there was a very strong kind of bull market run in the equity market over the last decade. And I think one of the benefits, as I mentioned earlier, of allocating in private markets is having that outperformance. And you'd want 300 to 500 basis points of outperformance on an annual basis above the respective kind of public market benchmark that you have for whatever asset class you're looking at in terms of when we think through from an allocation perspective. And we actually think what we're going to start to see in the current environment is a lot of managers over the last decade in the private market space were really able to just kind of rely upon multiple expansion from an exit perspective, and that drove a lot of their returns. I think now we're really focused on kind of manager. We're going to start to see much more dispersion in the returns from general partners over the next several years, and you're really going to see that widen out. Clearly in private markets, the dispersion of returns is much wider already than you see in kind of the public markets, where you can have, you know, anywhere from 10, 15, 20% splitting out kind of the first and second quartile, or even wider in certain scenarios as well. And so I think that manager dispersion, and really, so we think manager selection is very important, because you want to make sure that you have specifically within your portfolio access to first and second quartile managers, so that you can actually really make sure that your portfolio is really kind of teed up for success accordingly.
Yeah, I think that's actually a really good point. Not everyone's seen the research around this, but you know, in public markets, you hear it a lot where you know, there's a reason why indexing became so popular really over the past 40 years, is that the dispersion or the spread between the very best stock pickers and the very worst is very little. It's actually quite tight, because those markets, public markets, are relatively efficient. It's very hard to get an edge. And so your odds of like picking that top 1% manager out of thousands is very low, because that spread is not that wide. But then when you look at private markets, the spread is extremely wide. Like choosing a top quartile or top 25% hedge fund manager is going to drive a huge difference in terms of the returns you can expect to see versus someone that's at the median or below. And so something that I'm curious for your view on, we feel that the solution to the manager selection problem is half talent and half technology, and that's really, I would say, one of the driving hypotheses behind our platform is like, how could we better apply technology to manager selection, manager sourcing? In your view and in your experience, like, what has Goldman done historically to identify those managers and pick them out of the wide spread that we see?
So we actually have a team at Goldman called our External Investing Group, where they meet with 600 or 700 different private equity managers every year. They track about 10,000 different funds. And so I think we are very much focused on looking at historical returns. And I think, to your point, one of the parts of due diligence is actually how have they delivered returns? Was it multiple expansion? Was it value creation? Was it top line growth? How were they actually growing their portfolio companies and ultimately exiting at the end of the day? And that's something where even going forward, that's going to be a much more even important part of the due diligence, I think. Maybe just quickly, cognizant of time, you guys spend a fair amount of time on liquid alternatives, which I think has been an area in the private markets growth from an implementation perspective, has grown significantly in the last few years. And actually, I think that's going to continue to grow pretty significantly going forward. Do you maybe want to talk a little bit about what you guys do and why you think liquid alternatives are interesting?
Yeah, so like we were talking about earlier, traditional funds have a 7 or 10-year fund life, but liquid alternatives, that can apply to, traditionally that would only apply to hedge funds or certain types of investments where you can actually get liquidity maybe monthly or quarterly, but there's some new fund structures that are gaining a lot of popularity. You're seeing a lot of larger asset managers as well as some boutique ones take advantage of what are called registered closed-end funds. And these funds, what's different is that all of the holdings can be in alternatives, so things like private credit or private equity or hedge funds, but the fund structures allow for quarterly liquidity. And that's really attractive because many investors are held out of private markets because they either can't meet fund minimums, like if a minimum's 5 million and needs to be locked up for 10 years, there's really only a certain number of investors that can afford to take that type of illiquidity on that amount of capital. But with these fund structures, they often have much lower minimums. It can be as low as $50,000, and you can get quarterly liquidity. And so when we were thinking about seeing the rise in these structures, which has gone from, there was really only a handful of these types of funds 10 years ago and only a few $1 billion to now where it's into the hundreds of billions and there's a few hundred of these funds, we think that that's a really large trend. And so a lot of the tech that we use on our platform is around allowing consumers to sign up, invest through the platform directly into these types of funds, and then they can get exposure through these new fund structures as well. And I think that Goldman has recently registered quite a few of these types of fund structures as well. And so the hope is that it can make its way into a broader set of investors' portfolios in the next, let's say, 10 years.
Perfect. We would agree with you. We think it's going to actually provide access to a whole new universe of investors. With that, we are at time. It was a pleasure speaking with all of you, and hope you have a great day.
Thank you. Thank you, Tory. Thank you, Stephanie.